All right, today we're diving into a really fascinating company called Sharda Cropchem. It's in the specialty chemical space, and boy, has it been on a wild ride. It seems to be staging a pretty remarkable comeback, but if you look at its stock, it tells a kind of different story. So, let's dig in and figure out what's really going on here. So let's just get right to it. The stock is down about 31% from its recent peak, and that immediately brings up the million-dollar question for any investor, right? Is this a temporary dip, a golden opportunity to buy in? Or is it a warning sign of some deeper problems, a classic value trap?
To even begin to answer that, we've got to start with the company's financial performance, because honestly, the recent numbers suggest a massive turnaround is underway, that something big is changing for the better.
And just look at these numbers, they're striking. In the first 9 months of this fiscal year, revenue grew by a very healthy 29%. But that's not the headline. The real story here is the profit after tax. It has surged by a staggering 259% year over year. I mean, that's not just growth. That is an absolute explosion in profitability.
So you've got to ask, what's the secret sauce here? How can they pull off these kinds of comebacks? Well, it all comes down to their unique competitive advantage, what investors like to call a moat.
Now, Sharda's moat isn't built on giant factories or famous brands. It's built on paperwork. It's what's known as a regulatory moat. The best way to think of it is like this. For every single product they want to sell in a specific country, they need a passport or a registration from that government, and getting these things is incredibly difficult.
In their collection of these passports, it's huge. We're talking about nearly 3,000 active product registrations all around the globe. Every single one of those is like a license to print money in a market that locks out almost all of their competitors.
And this is exactly why that barrier to entry is so high. The whole process is just grueling. First, you apply, and then you wait. And you could be waiting anywhere from 1 to 7 years and spending millions of dollars for just one approval. You can see how that alone is enough to scare off most new competition and protect Sharda's turf.
Okay, so a great moat is one thing, but does it actually translate into real hard numbers? Let's check out how this passport portfolio is actually impacting the bottom line.
If we look at the recovery quarter by quarter, you can see a really clear positive trend building. Revenue is growing, the year-over-year growth is actually accelerating, and maybe most importantly, profitability, that EBITDA margin is consistently getting stronger and stronger.
Let's just zoom in on that revenue growth for a second. After starting the year with a solid 25% and kind of holding steady in Q2, it just took off in the latest quarter, hitting a fantastic 39% year over year. See, this isn't just a recovery. The business is actually accelerating.
And management clearly thinks this strength is here to stay. They're so confident in this turnaround that they've officially raised their profitability forecast for the whole fiscal year. Now they're guiding for some very healthy EBITDA margins, somewhere between 18 and 20%.
Okay, so the business is absolutely firing on all cylinders. And that brings us right back to our main question. The business looks solid, we've established that, but what about the stock? Is it trading at an attractive price for someone looking to invest today?
Well, if we use a key valuation tool, the price to earnings or PE ratio, it paints a fascinating picture. Sharda is trading at a PE multiple of around 15, while its industry peers are trading at more than double that, at about 31 times earning.
That is a massive 41% discount to the rest of the sector. It strongly suggests that despite this powerful turnaround, the market just isn't fully buying into the recovery story yet, which could mean there's some real value on the table for investors.
But hold on a second. A discount that big? Well, it usually exists for a reason. So before we get too carried away, we have to talk about the single biggest concern that gives investors pause and probably explains a lot of that valuation gap.
And here it is, 165 debtor days. So what on earth does that mean? It means that after Sharda sells its products, it takes, on average, 165 days. That's over 5 months to actually get paid by its customers. This massive cash lag puts immense pressure on their working capital, the money they need for day-to-day operations. It's a major red flag because the company is basically funding its customers' businesses, and that carries a lot of risk.
So, let's pull all these different threads together. On one side, we have a really resilient moat and a sharp financial recovery. And on the other, we have a cheap-looking stock, but with a significant cash collection risk. How does this all balance out?
So here's the summary of the whole situation. The bull case is pretty clear. A fantastic regulatory moat, an accelerating turnaround, and a stock that on the surface looks cheap. The bear case is just as clear. Those super high debtor days tie up a ton of cash, and the entire industry can be very cyclical, meaning it can have some pretty sharp downturns.
So the verdict from the source analysis is really one of cautious optimism. The suggested strategy for people who already own the stock is to hold, while potential new investors might want to consider buying on dips, basically picking up shares when the price weakens rather than chasing the stock when it's going up.
And now for the very important part. Please remember, this is an AI-generated analysis for educational purposes only and is not CB-registered investment advice. You should always verify all data independently before investing. All financial data is sourced from company filings, BSE/NSC disclosures, and publicly available analyst summaries.
So we'll leave you with this final thought to chew on. We've seen the powerful moat and the impressive recovery, but we've also seen the very real risk in its cash cycle. So the key question is this: will the strength of its business model be enough to overcome those risks and finally convince the market to value this stock much, much higher?
If you found this breakdown of Sharda Cropchem helpful, do us a favor and hit that like button. And of course, subscribe for more explainers just like this one. Thanks for watching.